Hi, this is PR Sundar. In the last few episodes, we have seen how the bond works, the pricing of the bonds, the bond yield, and how it is related to stock market. And I just mentioned that usually the rising interest rate is good for stock market, but why this time the markets are falling, markets are fearing. Okay, so this one we can understand if you look at the background. In 2008, what happened? The Lehman Brothers collapse. Everybody knows the economies all over the world faced a lot of challenges, and all the markets all over the world, stock markets fell. So that time, what the Fed did, they purchased a lot of treasuries. They purchased a lot of bonds and to inject the liquidity in the economy. So when more liquidity is there in the economy, so that will help the economy to revive. So that is called quantitative easing. So the Fed is injecting the liquidity in the market by buying the bonds and treasury bonds is called quantitative easing. That is done to improve the money circulation in the economy and to help increase the liquidity. And what happened? After 4 or 5 years, in 2013, the Fed thought the economy is doing well, so there is no need for our support. And they announced that we will be tapering, reducing the bond purchase. Since there is no demand for bond because they are buying less bonds, so the interest rate started moving higher. The bond yield started going higher. And what happens during the easy money, when the Fed prints a lot of money, buying a lot of bonds, injecting a lot of liquidity, and the interest rates will be very, very low. And some people bring those money to emerging economy stock markets. So emerging economy stock markets do very well. But when the Fed started tapering and the interest rate went up, so these people who pulled the money from emerging markets to US to pay back the interest because they don't want to pay higher interest rate. So that has created a big fall in stock market all over the world. If you can remember, in 2013, the Nifty fell nearly 20%. From 6,200, it fell to 5,100 or something. So I remember Nifty has fallen nearly 20%. 20% fall is a very big fall at the index level. Stocks would have fallen 40-50%. So this incident in a normal market condition, when the interest rate goes up, the stock market will go up. But here, the interest rate gone up not by itself is because the Fed decided to reduce the quantitative easing. The Fed reduced the bond purchase. Now what happened in 2020, once again, similar to 2008 Lehman Brothers collapse, 2020 was coronavirus, and again there was a lot of support from the Fed. The Fed kept the interest rates very, very low, and now economy is doing well. In US economy, all the economic indicators are really good. Economy is doing well. And because of that, Fed may think of increasing the interest rate, or the Fed may stop supporting the liquidity measures. And because of that, the interest rate is increasing. So because the people have seen in 2013 Taper Tantrum, and now they are afraid that, so something like that it can come now. And because of that, they are worried and they are selling. And that is the reason why Nasdaq has fallen 10%. And the markets are in jittery mode all over the world in the month of February, and in March also that is continuing. So if you go to Google and type quantitative easing and taper tantrum, you will get all these stories. As long as our economy is good, and I can tell you these are all the short-term fluctuations. In 2013, we fell 20%, but what happened after that? The markets went up. If you are a long-term investor, there is nothing to worry, but if you are a short-term trader, you may have to worry about quantitative easing, we may have to worry about taper tantrum. So we have to worry. I always say for fun, the more Indian traders are watching the US markets than the US traders watching the US market. And the music by US, and we will be dancing according to their music in the short term. So that is why in the month of February and March, late February, the early part of February, due to Indian budget, which was very good one, the market shot up. But from the third week of February, the market has been going through a turbulent phase because of this US Treasury bond yield rising. And last week, it shot up to 1.6. That's why the markets fell all over the world. And then it came down to 1.41. Now, from 1.41, now it has come back to 1.55. So, this video is shot on 5th of March. So, the data I am giving you as of 5th of March. So, there is nothing to worry very big about our Indian markets. But however, being a trader, we have to be very careful. And not last but not the least, the moment we are in futures and options segment, so we are considered as a speculator. So speculator is a Latin word, and if you look at the meaning of the word speculator, is a person who is standing in the front overlooking the enemy territory. Just to give you a simple example, India-Pakistan border, at the border area, the Indian soldier keep at the front, is standing and keep watching whether any enemy is coming to our territory. So how careful he has to be? He has to be careful for all the 24 hours. So the same way, we have to be very careful if you are a trader. If you are an investor, there is nothing to worry. I hope you enjoyed the video. Thank you for watching.